What do you mean there's no coverage? What am I paying for all this insurance for? Are these questions you've asked? Does it seem like insurance policies have hidden technicalities meant to take your money just so they can deny coverage? Does it seem like the purpose of the entire insurance business model is to create a policy that finds a way to not pay? If any of these are questions, thoughts, or beliefs that you've had, this video is for you. Hi, my name's Eli Gillespie, and I'm the owner of Gillespie Insurance Services in Redlands, California. Today, I'm going to dive in and attempt to explain a critical piece of policy mechanics that most people have zero understanding of that may have left them with these negative insurance feelings. My goal is ultimately to close your insurance knowledge gap and bring a small amount of peace to your life if you've ever been lost and confused, twisted and used by an uninsured claim. The way I'm going to do that is I'm going to explain the difference between an occurrence policy and a claims made policy. Then I'm going to discuss a common misconception, often, typically among contractors, but likely also among any business that sells products or completes projects that can exist in the world with exposure to loss long after the date of sale or the date of completion. What I mean by that is you build a house and you sell it, or you complete a service or repair job. You manufacture a product and sell it, and long after that completion or sale date, a claim occurs. I'll explain which policy responds in that situation. Okay, so we're going to look at two types of policies, occurrence and claims made. Occurrence policies are the most common type of liability policy that we have. Commercial general liability, workers' comp, liquor liability, auto liability. These are all occurrence-based policies. Even homeowners policies that have liability coverage on them, homeowners, renters, they are also occurrence-based policies. Okay. Even property policies. Now, we're not talking about property insurance, but property policies are occurrence-based. They are by far and away the most common type of policy. Our other type of policy is claims made. Okay. So this is where your most of your management liability policies are found. Management liability policies are everything from errors and omissions, professional liability, employment practices liability, directors and officers. Even certain crime policies are are on a certain type of a claims made that's a variant, a little different, but essentially the same. And that's called a discovery policy, I think. I'll have to research that. But those are the two types, okay? Claims made and occurrence. So it's the answer to which policy would pay is actually completely more simple than you might think. It's just when did the damage occur? So in an occurrence policy, it's when did the damage occur? When the damage occurred, that's the policy that's paying. In claims made, it's the opposite question. When was the claim made? Doesn't matter when the damage occurred. When the claim was made, the policy enforced at that time, that's a policy that's paying. So I'll illustrate with some simple examples. All right, so let's just say you are a business and you cause bodily injury or property damage. You cause fire damage. It's not your building burns up. You cause someone else's building to burn up. You cause someone else's property to be damaged. And that's a liability claim coming to you. So you cause damage in May, and in June, you get a phone call or a letter from their lawyer saying, you caused my client damage, you owe us money. All right, so of all these policies, way back to 1986, 25, 26, 27, which policy pays? Well, that's pretty basic. Okay. 2026, the current policy pays. Okay, no brainer. Now, let's look at a claims made. So in claims made, the damage occurs in May, the financial loss occurs in May, the wrongful act occurs in May, and you get a call in June or July for financial restitution from the injured party. And so what policy is going to pay? Well, that's another Captain Obvious. Okay. The current policy, the existing policy, the damage and the claim were both made. Claims made, we don't care when the damage occurred. We just care about when the claim was made. And in the occurrence, it was the opposite. All right, so let's get a little trickier again. All right, so let's just say the damage occurred in 2025, but they don't call you until the next year. How could that be? Believe it or not, it happens quite a bit. A lawyer says, last year, you caused my client property damage. We did an investigation. It was your fault. Now we're filing the claim. Okay. So which policy pays? Well, with occurrence, we just asked the question, when did the damage occur? And so we have our answer. The damage occurred in 2025. So the 2025 policy is paying. So if you called your agent and said, I have a claim to report, they're going to hope you had insurance last year because that's the policy that's paying, not the current policy. Okay, with claims made, same scenario. Which policy is paying? The current policy. Why? Because when was the claim made? This year. This year's policy pays. Okay, now let's get historical just to show you that the timeline works. What if the damage occurred in 1986 and 40 years later they call you up and said, back in 86, your business caused bodily injury to a group of our clients, the lawyer, the class action lawyer, from way back then. We just discovered this injury now. We're filing a claim now. Well, which policy is going to pay? When did the damage occur? The damage, it's been happening. It happened. It started in 1986. That's when it happened. We just got together 40 years later. That's rare. It's rare that happens, but that policy would pay. Got to go back to 1986 and find out who you were insured with and hope they're still in business. Okay, now let's go to claims made. Same scenario. Which policy pays? Well, good question. When was the claim made? The claim was made this year, 2026. This year's policy pays. Doesn't matter if you had insurance. It doesn't matter when the damage occurred. It just matters if you have a policy now and it's claims made, then it's covered. We're assuming this is a covered loss, by the way. Every example, we're not saying, is this excluded? In a real analysis, you're going to say, is this a covered loss as well as, or a limited loss, or is there some exclusion? We're pretending it's covered. We know it's covered. It's a covered loss. We just have to determine which policy is going to pay. So thus far, I'm saying claims made has the advantage, right? I would rather if something came up, dug up from the past, was dug up from the past and came in today, I'd rather have today's policy pay because I don't have to go try to figure out who I was insured with 40 years ago and hope and pray they're still in business. So far, claims made has the advantage, right? Well, not so fast. Yes, it does have an inherent advantage in some ways, but in the real world, claims made has what's called a retro date. Okay? So a retro date is a wall. It says as long as the damage didn't occur before the retro date, you're covered, assuming it's a covered loss, and we are. So the damage occurred in 2025. The call was made in 2026. Which policy pays? Well, when was the claim made? We have a covered loss on this policy. Okay. So now let's go back. Damage occurs in 1986, whereas previously Whereas previously there was coverage all the way back for the occurrence in 1986. Whoops, sorry. Put that back. Now you find yourself in a situation if the damage occurred before the retro date, there's no coverage. None. None at all. Uninsured claim. Why? Well, as explained, the damage occurred before the retro date. So on occurrence policies, there's no retro date. There can be such a thing as as a sunset clause. I'm not going to get into that. You don't see it so much anymore. But in an occurrence, there's no retro date. There's no the insurance expired, therefore not paying. So now occurrence seems to have the advantage because of the retro date. So I agree with that. Now, going back to the retro date. Retro date, not a big deal if you have a long retro date. You could get a retro date back to 1986. Let's just say you're a business that's been in place since 1986. You've been insured the whole time. Well, more than likely, you're going to have yourself a retro date going back to 1986. Quite possible. Usually, your retro date is based on the first year you had coverage. So, there you go. Long-standing businesses with continuous insurance can keep that long, way back in the past retro date. And that's obviously advisable how we advise it. That's the way you want to do it. A problem that I've seen occur is when it's either a do-it-yourself situation or you're dealing with an agent that doesn't really understand this stuff and they set you up with a policy. You say you switch insurance companies and you find a better rate and you find a really good rate on a claims made policy for your E&O and you don't know how E&O works, but you know you're saving some money. Could it be that the reason you're saving money is because your agent or the form you uploaded to get that quote didn't make it clear about what the retro date, or the agent didn't understand the retro date or didn't ask, and they put a retro date of the first year of inception of this new policy? Okay, if that's the case, you find yourself with a claims made policy with a brand new retro date on the first year of this policy, you're finding yourself with no coverage, even if the damage occurred just a day before the policy went into force. Okay, so that's the danger of claims made is watch the retro date. Occurrence policies, we don't deal with retro dates. Now I'm going to come to the misconception part that I told you I was going to talk about. And this is the one that occurs often among contractors. But like I said, it can occur among anyone that sells a product that stays in the world and then later on has a loss. Okay, so first I'll discuss a contractor. So let's just say you have a contractor that built a house in 2025. The damage occurs, the house burns. You built the house, you sold it in 2025. The house has some damage. Maybe it's water damage, something that's not totally noticeable. Who knows? It's wind damage because there was a gap in the window and the wind came in and the house was getting damaged. And so the client, the new homeowner, discovers the damage in 2027 and calls in the claim. Okay, that's how feasibly it could happen. And trust me, it happens. Distances between damage and claim. All right, well, we're on occurrence policy, so no big whoop, you're saying. Which policy pays? Well, it's not the one from 2025, it's the one from 2026. Why? When did the damage occur? It occurred in 2026. Okay, same thing with, let's say you're a winery. You sell a bottle of wine. In 2025, they hold on to it for a year. They drink it in 2026. That's when the damage occurs. They get so sick from it, bodily injury claim. They call you, they get sick, they drink it over Christmas. They call you after the new year. Which policy pays? Okay, no brainer. Still 2026 because when did the damage occur? And we can make the same case about a restaurant. Um, had a party, New Year's Eve, sold a bunch of food. Everyone went home. A week later, I started getting all these calls. Okay. So in this case, sold the food in December, but the damage occurred in January and the call was in April. Okay. When did the damage occur? January. No big whoop. Okay. So what's the big misconception and what's the problem? So far, this all makes sense. The misconception is that many people, I'm going to pull the restaurant down. It's not as valuable as a tool for this, valuable of a tool for this. A lot of contractors believe, I'll stick with the contractor here, that I had insurance when I built the house. I was done with my project. I didn't have any more projects that were completed or ongoing. This big project ended, so I was done. I took a year off. I don't have any insurance anymore. I don't need insurance. I'm not doing anything. And in that time period, that's when the damage occurred. Doesn't even matter when the claim was made. I built my house, finished in November. It burned down in 2026. They called right away. Which policy pays? Well, okay, we all know the 2026 one pays, but our contractor didn't renew insurance because he was done. He didn't have any projects in 2026. Why would I keep insurance if I don't have any projects? Did you retire? No, I didn't retire. I just didn't have anything going. I'd start a new policy when I start my new project because many people, mostly contractors, believe that the policy that was covering the insured at the time of the project is the one that pays. It's not. This is not a project-based policy. It's an occurrence-based policy. When did the damage occur? Not when was the project completed. And so, same thing. Say the winery sells the wine, sold all their wine. They're a small winery. They're not selling any wine this whole next year. They're going on vacation to Italy to do some research, and they don't have insurance in 2026. And so I'm going to gray this out. There's like, it's not just not covered, there's just no insurance. Okay. Same thing. I sold, okay, the damage occurred today, but wouldn't last year's policy paid it? Because that's when I sold the wine or sold the product or finished the welding job or finished the service and repair job or sold and delivered the furniture that collapsed in 2026. No, it's not projects complete policy or sale complete policy. It's when did the damage occur? That's the only question we ask. And yes, there can be limitations on contractors, which I mentioned sunset clause and I'll mention prior works exclusions. Those are two exclusions that are for another time and another place. But I just wanted to clear up this misconception because it can be a doozy. I've seen it. I've seen uninsured claims occur because of this, and the insured being totally lost and confused, twisted and used because they didn't understand how insurance works. So that's my goal here is to help you understand how insurance works in terms of occurrence policies and claims made policies. Okay, last but not least, you're saying thank you so much, Eli. This was wonderful, enlightening, entertaining, educating. I'm now at peace. I understand more about how insurance works, and I would like to consider working with you. Okay, you don't have to work with me, but you can consider working with me. And if you would like to consider working with me, which means get a quote on insurance from our agency, and we would be your agent. If you like the quote, I can help you with that. So the way to do that is just go to our website, gillespieInsuranceServices.com, and go up here to the upper right, hit get a quote, and you just fill out the form. It'll go to one of our agents, and our agent will input. I'm sorry, you would do the input. Our agent will call you and have a little conversation, learn a little bit more about you, your insurance needs, your business operations, and get back to you with a no obligation, no pressure quote, no cost too. Quotes are still free. And should you like the quote and want to go with it, we can do that. And you would then therefore become a client of ours and we'll be your agent. We do workers' comp, general liability, business owners policies, employment practices liability, umbrella, auto, property. We do all these types of businesses and we love to insure restaurants, contractors, farms. I'll put the link below. Please like this video, maybe even subscribe to the channel. That helps us get out there. Maybe even leave us a comment. It could be a question. All those things are great. We appreciate them. I will personally reply to you. So thank you again for watching, and I will see you on the next video.